Hey guys, it's Josh Brown. I'm here with Michael Batnick as usual for another game of What Are Your Thoughts? We're going to talk about some of the biggest topics on Wall Street this week in investing, in business, in finance, etc. Stick around. All right, so Mike, I need like a little bit of a setup for my first one.
Okay.
I know that you're fully aware of what's going on, but I just want to make sure everyone in the audience has the background. So the Ark Innovation Etf, it's ARKK. It's up over 80% over I think year to date or over the last year, and it's up over 450% over the last 5 years. And it's run by a woman named Kathy Wood, who's done an outstanding job. She's been absolutely right about some of the biggest trends in innovation and technology. Big believer in Tesla all the way up.
Can I step in?
A lot of heat for that. So she now is on top of the go.
Wait, this is important. So Ben Johnson tweeted a chart last week. Mean reversion rules everything around me. And what he showed was the best performing unlevered ETF from 2009 to 2017, followed by their subsequent 3-year annualized return.
Yeah.
And not shockingly, after you were the best performing ETF, you didn't do so great over the next 3 years. So for example, in 2010, Invesco Silver ETF was up 82%. And in the following 3 years, it annualized at negative 16% a year. You follow? So in 2017, ARKK was up 87%. Okay. So by 2020, it will have 3 years annualized performance after that. If the year ended today, it would have compounded at 40% a year following being the best performer in 2017. So it completely broke all the rules of this.
Do you recognize what's different between this and every other ETF in Ben's study?
Yeah, this is active. And she crushed it.
So when you look at a silver ETF, mean reversion in asset classes is very understandable, very well documented.
I disagree. Actually, you're more likely to mean reverse as an active manager than as an index.
Versus your benchmark, not necessarily versus your own performance.
Making this even more impressive.
Yeah, look, at the end of the day, she's winning big. And
all right, so what did she do?
So I think the ETF's over $10 billion, and I was really surprised. You actually shared this with me on Friday.
Are you an investor looking for long-term capital appreciation, but worried about the short-term volatility associated with innovative companies? Well, you're not alone. Many investors appear to be afraid of companies that offer newer, faster, cheaper, and creative products and services. Now you can avoid these innovative companies. How? Ask your advisor today if investing in a traditional broad-based index is right for you. A broad-based index provides investors with a feeling of safety and comfort, knowing that they hold past success.
And I was laughing. I thought it was really well done, but she's now running parody videos, making fun of value investors, taunting people that weren't like fully invested in the most innovative stocks. I just feel like it's a bad look. What do you think?
Why tempt fate, right?
What do you mean?
This is bad.
It's not even about fate. It's about other people.
No,
Forget about the magical element of it.
This is bad. This is bad juju. Like,
all right, so I'm not superstitious. I'm not superstitious.
Well, neither am I. But it's almost like you're asking for it. If this turns.
So that's all right. So that's what I'm saying. Actually, so I put something up about it yesterday. Like, dude, you just won. Nobody likes a sore winner.
Right.
Why are you kicking sand at people? A couple of heavy hitters that have been on Wall Street like twice as long as I have, like old school people, they were like, she's really smart and she's a really good investor, but you're dead right. Like, why would you do this?
It's funny, but I don't know if it's a great look. I guess counterpoint is, listen, she's winning and she wants to go for it. She wants people to know that they're kicking ass, and why not strike while the iron is hot? And what did you say the total assets were in here? Whatever it is.
I think it's 10 billion, but for an active ETF, with only a couple of years of track record, that's a lot of money.
That's amazing. Okay, so 10.6. She's like, what? We should be 50 billion, 100 billion. Let's go for it. I'm making that up. I don't know what she's thinking, but I mean, I will give them credit. It was clever. The commercial was funny, but when I saw it, I was like, I laughed and I said, all right, let's. A lot of people are gonna look back on this, the remind me in 3 years tweet or whatever.
All right, so now you're saying like she should get credit, the Ark should get credit, they should be 50 billion, whatever. So think about this. One other thing she deserves a lot of credit for is the fact that she's doing full on overnight holdings transparency like a passive ETF. So you can download all of the holdings.
Yeah, it's right there.
So you know the buys and sells, but not every active ETF is allowing that. There are a dozen what are called non-transparent active ETFs that have come out from some big firms, and they're doing active ETF, but you don't know what they own. So kind of like a mix between a mutual fund and an ETF. But she's like, investors like transparency. So this is how I do it. Are you really going to love that when you're 50 billion and people are front running your trades? Maybe not.
Right. All right, let's move on.
Okay. What do you got?
Gavin Baker did a post, why category leading brick and mortar retailers are likely the biggest long-term COVID beneficiaries. Did you read this?
Yeah, I loved it.
I thought it was really, definitely something that I was not on my radar at all. Let me just read you a few things. He said, if most e-commerce companies have been pulled 1 to 3 years into the future in terms of their revenue, then the e-commerce business of most category leading brick and mortar retailers have been pulled 5 to 10 years into the future. So for example, Walmart's digital revenue in Q2 was an annualized $42 billion, growing 94% faster than Amazon. Best Buy's digital revenue, $19.4 billion on an annualized basis, growing 242% faster than Amazon. And what he was basically saying is that Amazon's retail business may actually be disadvantaged due to COVID because everybody else is forced to catch up. And now there is an onslaught of real competition. And I think he's dead right.
Well, you can see that. Look at the share prices of Walmart and Target. These are not trading like stocks that are being threatened by Amazon. And the premise, Baker managed the OTC stock fund for Fidelity. So this guy's like, not like I started a Substack this morning. This guy like fucking knows what he's talking about. And he was basically saying that this idea that owning retail stores was powerful kind of been in the ether since 2014, 2015. And now it's become like almost overnight obvious. And he was saying that when did Amazon buy Whole Foods? 17? Whatever. He's like, the day that happened, I had the biggest turnover in my mutual fund portfolio ever. I moved $2 billion worth of assets that day. And I think what he was trying to do was buy retailers, category killing retailers, because that was the realization that, oh, wait a minute, Amazon wants to be local to people, and omni-channel is actually the answer. So I think the implications of this piece are really clear, which is that all of the gains that companies like Shopify and Amazon have seen, they would have seen anyway. It just happened quicker. But now what's really changed is that, like at Home Depot, at Best Buy, the data analytics and the e-commerce people aren't halfway across the campus somewhere. They're sitting next to the CEO's office. Well, also, and all of these companies are overnight like getting extremely serious about doing omni-channel. And it's working.
So you buy on your phone. For example, Home Depot has an app. You buy on your phone. You go to the store to pick it up. It's way cheaper than shipping. But look at this. Look at this chart of Amazon quarterly revenue growth from the turn of the century. It's a straight line up. I mean, it's still growing. It's still growing.
That looks like an old school like telephone cord.
I mean, yeah, it's unbelievable. It's still growing uninterrupted, 20% plus a year. I don't know how much of this. In other words, let's say that the retail business does slow down, or it decelerates. Instead of growing 20% a year, it grows at 12.
Right.
I wonder what, if anything, that does to the stock, considering that most of the gains are coming from other parts of the business.
Can I give you another one? Just throw it on your radar. I don't own the stock. When was the last time you looked at Gap stores?
I know it's doing very well.
Take a gander at this.
I do look at it. Yeah. Hey, guess what?
What?
I'm pretty sure. Can you see this?
Yeah.
Wearing Gap shirt right now.
Are you?
Yes, I am.
Oh wow! Look,
it's old, so I don't care if I stretch it out. But yes, I am.
It's not Banana Republic.
Straight Gap.
Because you didn't go to grad school. It's straight up Gap. Here's a situation where a company's figuring out omnichannel in real time. You could watch them do it. Gap got a new CEO. Get this, March 23rd.
My birthday. And the bottom.
Literally the bottom of the stock market, and the moment that it felt like the world was coming to an end, they made a leadership change. So Gap was going to spin off Old Navy.
Who cares about Gap?
Old Navy's the best part of Gap. They were going to spin it off, and the woman that was going to lead it as a standalone company was going to go with Old Navy. And they said, forget it. You know what? No spinoffs. You're the CEO, and you have to do for Gap what you did for Old Navy. And she built Old Navy into a monster. So this is a company, they're looking at Lululemon's playbook. Now, when you think about e-commerce and you think about traditional category killers in apparel, nobody thinks that any of these companies can survive. And I think if Best Buy can survive in consumer electronics, then there are going to be apparel companies that survive. I really just don't see Amazon taking apparel from everyone. So I'm looking at some of these stocks the first time in a while. All right, let's move along. I wanted to get into this thing from our colleague Blair Duquesne, and Blair's an advisor at Ritholtz, and she's talking to clients all day, and she writes the Bell Curve blog. This is Blair. Quote, I am hearing a lot lately that investors are waiting until after the election to invest cash. I get it. This election is the most polarizing in my lifetime, in all of our lifetimes. Throw in a 100-year pandemic, the expansion of mail-in voting to ensure voter safety, and almost guarantee that we won't know results on election night, and a president who agrees to the peaceful transfer of power, and we have ourselves a pressure cooker of uncertainty. But markets rarely behave in the way a majority of us expect. So here's what I want to ask you. She's basically like, look, there are two scenarios. One, no matter who wins the election, the market rallies because that uncertainty is gone. And then are you going to want to buy then? Like you want to buy them higher? Probably not. Scenario two, it's chaos or the market hates the outcome. We fall 10 to 20%. You're not going to want to buy then either if you've been sitting in cash. Correct. Because that's when it's going to... down 20% is when you think the market's about to go to zero.
Well, that's when your worst fears are confirmed. See, I knew it.
What do you mean? What do you mean by that? You convince yourself that you were right all along.
Yes.
Things going to get worse.
So that's why cash. That's why cash is so dangerous. And thinking all in, all out, you can't do it. You just. How many people do you know that successfully invest that way? I'm in, I'm out. I'm in, I'm out. Nobody. You can't do it. So if you're sitting,
I know the people that try. That they're fools.
If you're sitting in cash waiting for some sort of resolution, to your point, two things happen. One, there was a peaceful resolution and the markets like certainty, whoever wins, and stocks go higher, right?
Yeah, you're not buying. You're not going to buy.
And then you're like, shit, all right, now I'll wait for a pullback. Or it's a mess. The market doesn't like the outcome, whatever. Markets fall 10%, they fall 15%, and your worst fears are confirmed. See, this is why I was in cash. So
and you're definitely not buying that dip.
No, definitely of course not. So it's just you can't do it.
When you talk to people that are all in cash, like we don't see them anymore, but we saw them. Barry and I saw them from like 2011, 2010,
probably to
2011, 2012. Yeah, I mean they're still out there, but we were talking to people that were like, no, I'm 90% cash, I'm 10% gold. Like for them, the cash is like the precious. It's like Gollum in Lord of the Rings. Like the cash can't be out of their sight for a second, and they would never part with it for anything. Like it really becomes like an obsession, and they're so focused on using it at the exact perfect time that they never reinvest it.
However, if you are invested in a portfolio, whatever your allocation is, it could be all stocks, all mutual funds, all ETFs, whatever, and you have a slug of cash that you got from work.
You got that? It sounds like Barry. Barry says a slug of cash, right? You totally got that from Barry.
You have cash, whatever, from whatever wherever it came from, you have a piece of cash, and you wait until after the election. All right, I can understand that. Like if you've had this money sitting, why put it in? Like why put it in now? I get that mentality. I don't think there's like anything terribly wrong with that.
With 2 weeks left to go for the election, fine. I think we're talking more like I'm all in cash waiting for the opportunity. All right, I hope you get it.
Right? Yeah,
you might.
That's not. Yeah,
you might. We'll see if you have. We'll see if you could actually pull the trigger.
That's not gonna work. All right. So I don't know what in the world is going on with flows into and out of the NASDAQ 100 ETF QQQ. This is now almost $150 billion ETF. It's one of the biggest. In fact, they just rolled out QQQJ 101 to 200 and QQQM, a cheaper, different structure version of the NASDAQ 100. Anyhow, be that as it may, this has seen an average of $1.5 billion per day inflows over the last month. In September, it had its biggest withdrawal in 2 decades, and that makes sense. The numbers are bigger now than they were. But then the very next day,
I was going to ask you percentage-wise, are these numbers as wild as they sound in dollar terms?
I haven't done that, but I do suspect that it is, because Sentiment Trader had this tweet 3 weeks ago. Large speculators were net short about $47 billion worth of equity index futures. As of Tuesday, they're net long about $25 billion. That $72 billion swing is large. And so I think what's going on is a lot of option desks are using the Qs to hedge. I think that's pretty much what's going on.
So they're doing index options trades to hedge individual positions?
Or Apple options, Facebook options,
right.
and those
That
are
makes
such.
sense to me.
I mean, those basically are the Qs, right? Like Apple is what, 25%. Microsoft.
I feel like we saw activity like this in the spider in S&P in like 2011, 2012, when like people were just doing massive hedging or very, very short-term directional trades, and they were just using the index, the index ETF. As much as they were using like index futures.
Okay, so Apple's 14%, Microsoft's 11%, Amazon's 11%. So I mean, for all intents and purposes, if you want to hedge out these options, this is not a bad place to do it.
No, and then the question is like at a certain point, are you hedging so much that you might as well just lighten the thing that you're hedging? Like I always wonder, like, how much hedging do you need to do? Maybe you just own too much.
Well, I think these are the big banks. I don't think it's necessarily the end investor.
I think it's like hedge funds. You think it's banks? Probably both. If it's banks, we'll find out, because one of them will fuck up royally. And
you think the London whale is back, or the Japanese whale?
The London whale.
The Japanese whale. Remember, there was a story like 2 months ago. The Nasdaq whale. The
Nasdaq whale.
SoftBank. Anyhow,
the only whale I'm interested in is Fudgy the whale.
I knew that was coming.
All right, I wanted to ask you what you think would produce the bigger immediate stock market rally. So not over 6 months, but like over a week.
Okay.
A stimulus bill makes it through the Senate, the president signs it. Or B, vaccine approval for the cocoa. Like, which would the market rally more furiously and harder from?
All right, this is a complicated question. I'm going to answer it, and then I'm a
complicated guy.
I'm going to answer it, and then I'm going to not answer it.
Oh, that's great. The viewers are going to love that.
I'm going to answer it. A vaccine. Right. A vaccine.
But I feel like if there is a vaccine, then a lot of the value, the cyclical stocks will absolutely rip. The reopening trade, the cruises, on the vaccine.
Yeah, the cruises, the airlines, the casinos, the hospitality resort, all those sort of stocks. And I think that you might see some of the biggest beneficiaries of the shutdown or of COVID, the giant tech stocks, you might see them pull back in the catch-up trade. So I think that, I don't know that would move the indexes so much. You understand what I'm saying?
Yes, because the types of stocks that would rally on a vaccine aren't big enough.
Correct.
I don't think that would matter. I think the market goes crazy on either one of these.
Okay. Don't disagree. However, the non-answer is I do think that if there is not stimulus, in other words, if both parties say, sorry, can't come to a deal, if there is no stimulus, then I think the market pulls back. Healthy. It'll be a healthy pullback, of course. But like, in other words, I don't think the market is
you don't think a stimulus bill rips the market higher?
I do. But I'm saying, I think the market is sort of anticipating that. I don't think the market knows where the vaccine is coming from. But I do think if they say no stimulus, then the market will
With all due respect, a vaccine seems more likely than a stimulus bill.
With all due respect. It's a weird thing to say.
At the current moment.
In this forum, that's a weird thing to say to me.
At the current moment, with 2 weeks to the election, a vaccine seems like a surer bet than a stimulus bill in the next month. Here's what I would tell you. I used to say that a vaccine would be the biggest market rally we've ever seen in our lifetimes. Like, I was saying that quietly to myself. But now I'm thinking...
The voice in your head changed its mind?
Yeah, because now I'm thinking nobody's going to trust it and there won't be enough. And the market will have
dark.
A one-day rally, and then the next day...
That's too dark.
All the Wall Street analysts will be like, yeah, but You know what I'm saying? Like they'll be like, "Oh, it's great, but here's why it's not going to help. Here's why it's not going to matter in the next quarter or whatever."
I have one more quick topic, and we don't have much time, so I'll go very quick on this. Mark Rubenstein did a post on buy now, pay later companies. So you've got the one that I know is Affirm. It's thinking about going public and wants to raise between $5 and $10 billion. There's a bigger one in Sweden called Klarna, and there are some wild statistics in here on this market. Retailers typically see a 68% increase in average order value with installments. So in other words, just to give you an idea of what we're talking about, I bought a Peloton. I didn't pay for it. There's this company called Affirm that I pay $63 a month for.
They pay for it and they make installments for you.
Exactly.
Right.
There's a 58% boost in average order value for retailers offer financing. And there's a 20% increase in purchase frequency for customers shopping with pay in 30 days. So behaviorally, the opportunity here is enormous. It's still a tiny market. So far this year, the main buy now, pay later companies, Rubenstein said, financed around $40 billion of sales globally, compared with $10 trillion credit spending through Visa, MasterCard, Amex, and Discover. So the credit card companies at this point have done 250x these buy now, pay later. I think there's an enormous runway ahead for these companies.
All right, so a couple things. First, my wife is like one of the biggest online shoppers I've ever seen, like on the planet. It's not that she's buying stuff all the time. She's just always looking. I asked her if she sees these things in the shopping carts. She's like, I see them all the time. I have no idea what they are. But she's now aware that this is like a thing. I was really not. And then when I read this article, I started to look, and then I realized, oh, Affirm is all over, like everywhere. The 3 or 4 sites I buy things from. So somebody said it's like the new digital online version of layaway. It's not really, because you get the item immediately. It's not like you're putting money down and then you have to wait and go pick it up. So it's actually better. And I agree with you. Like this could be disruptive to Visa, MasterCard, PayPal, unless they come up with their own version. Because
well, why don't they just do it? I guess maybe because it'll cannibalize what their existing business.
I don't know. I think they want the interest. The e-commerce companies, the retailers, this is amazing for them because they're getting paid immediately. Affirm is taking the credit risk. They're just paying.
And people are spending more money.
People are spending more. The shopping cart's bigger, and they're coming back. I think I read they're coming back more frequently to that same site because it's like a really great solution. Yeah. Then the question is like, well, what kind of credit risk is Affirm taking? Or Klarna?
Losses were not that bad. It was in this article.
But if they're not charging interest or credit card level of interest, how are they making money?
I guess the merchant's paying them.
Oh, I know how they make money. What they do is they file for an IPO and sell all their shares to me. That's the business model.
Listener question. What do we got?
All right.
Duncan?
Okay, so this week's question comes from Scott, and he writes, please do a discussion on the buy and hold versus trading philosophies of investing. For younger investors like myself, this is the biggest choice that we face.
I got to take. I don't think it has to be a choice. And I think that you can do both. You can have your core index funds, and then if you want, you can trade around them. You can own active mutual funds. It doesn't have to be. It's not black and white. There is room for both. Josh, isn't that what you do?
You know, I went to Jim Cramer's book party a couple of years ago. His most recent book, and the first paragraph of the first chapter is, put the first money you have in the market in index funds. That's Jim Cramer. That is literally the god of retail people trading their own money. And he's like, he's just like, look, obviously indexes, and then the trading should be for like learning and fun and maybe to make a little bit more than you can with the index. I think that's the right approach. That's what I do. And anyone that tells you have to choose, they don't live in the real world. And I have a whole book coming out about how people make decisions for reasons other than pure Vulcan logic with their own money, financial advisors. Like
fun, excitement, hobbies, interest.
Yeah. How do you learn the market if you just buy, I'm not saying you shouldn't just buy an index fund, but then you're not going to know anything about why it's up or down. And if you don't care, no problem. You might have other hobbies. You might be playing video games or pinning the wings of a butterfly to a board or some other freaky shit. My hobby is investing. I want to own individual stocks alongside of the index funds. And by the way, it's not going terribly. I got to be honest with you. So don't listen to people that tell you, Scott, don't listen to people that you have to be somebody other than who you are. I want you to trade and I want you to invest. And I want you to have fun and learn while you're doing both. I don't have a wrap up to that.
I was waiting for like a.
No, I'm serious though. No wink.
Yeah,
No wink,
that's good.
Scott.
That was
Trade
good.
them well. All
All
right,
right.
guys, let us know what you think. We love your feedback. It's amazing. We appreciate it. We vibe off that. We love when you guys show up every Tuesday night to the live premiere, so keep doing that. Over 500 people last time. So exciting. Smash that like button. Tell your friends about the channel. Are you a subscriber? Oh my God, what are you waiting for? You got to subscribe, and we will be back very soon.